All right, guys, what's going on? We're here at the Pat Grace Real Estate Show, Kiss My Assets. And this is the show where we pull back the curtain, show everybody how I created this $60 million portfolio in Kansas City that makes a couple $100,000 a month in passive income. And we've got real deals, real operators, real numbers. And if you don't know who I am, my name's Pat Grace. And we're here on this show talking about cost segs today, so buckle up. It's not going to be boring. Today's episode is about saving money and not paying taxes. One of the most powerful, most understood, and very legal way to keep your money where it belongs, which is in your pocket and not paying Uncle Sam. The truth is, most investors don't want to hear this, but you're probably overpaying on taxes right now. And it's not because you're doing anything wrong. It's because nobody told you about cost segs. That's the situation I was in. And so cost segregation allows you to depreciate your assets and take a lot of it in year one and front loading those deductions instead of over 27 years. And so most CPAs don't know about this, and they want you to depreciate over 27 years. So, we're going to teach you guys something new tonight, help you guys grow, get bigger, get faster, and get stronger. And tonight we're breaking it all down, what a cost segregation really is, how much you can actually save. We're going to go over some rent numbers, some sale numbers, and we're going to discuss the World Cup and what's that about, how it's going to affect the real estate market, and how you can make some money in the 3 months that the World Cup is going to be in Kansas City. So let's get into it and talk about the market real quick. Let's look at the sale market in Kansas City. This is stats from KCRAR as of February. And so, as you can see, we've had an uptick in closed sales. It's up 12.3% from last February. So we've closed 12% more transactions this February than last February. The average sale price has went up to $370,000, which is great for the market. Price action's going up, closed sales are going up, and the days on market is also going up. So 57 days on market. So those of you who, we're all missing the days where we was putting homes on the market and selling them in, a day, 2 days. That's not happening anymore. Inventory is also up. So a lot. Almost 10%. And, rates are high. We've got this war situation going on. And so there's a lot of people just kind of on the sidelines right now. And we need to figure this out. I mean, I think my guess and what I'm assuming is going to happen is nothing is going to happen for the next couple months until we get this new Fed chair in. And he's probably going to cut rates at that point, and hopefully the war is over and, we can kind of get going in June, July. And I can see a few rate cuts happening this year, but I can also see big inflation. The dollar's very weak. A lot of countries and a lot of people have sold the US dollar. And so we'll see what happens in the future, but I do think rates will drop and we'll start seeing a big pickup here in Kansas City, especially in our busy months of June, July, and August, our summer months. And so if you're looking at buying properties, you're looking at buying homes, right now might be a good time to take some positions in some properties before the market floods with buyers and low rates. And at that point, you're going to be highest and best and multiple offers. And so let's move the slide and talk about some rentals. So On the rent market, we've got some upticks on the rent market as well, but I do see slowness. This month was crazy for me. Like, I'm renting homes that are becoming vacant, and the tenants haven't even moved out, and we're renting them this month. But this is the first month that I've seen this in about the last 3 to 4 months. So I think maybe the weather and we're getting into a busy space right now. Maybe a lot of people might have pulled their homes off the market for the World Cup, and to make that money and to go down that route, that could be played in here as a factor. But Jackson County, the average rent's about 1,495. Let's just say $1,500. People are getting a good 6 to 7 cap. Taking about on average 3 weeks to 4 weeks to lease those properties. The 3 bedroom house on average is about 1,600, and the 4 bedroom house is about 1,900 in Jackson County, Missouri. In Clay County, we have the average rent about 1,600. I mean 1,700. Sorry, they're saying that's up 2.8%, but I really feel like it's down. And I can feel that as well. I own a lot of houses in Clay County, north of the river, and I'm renting my homes for less, especially over the January, February, and March months. We did rent a lot of homes for less price, and in order to make up for that, I really just did 6 month leases on a lot of properties so that I could renew the leases in the strength of the year, which was going to be in the summer of this year. And so think about that as an investor. You don't have to do 12-month leases. And when I rent homes in December and January and February, I don't do 12-month leases because I never want those homes to expire in the winter. So just a little nugget there. You can do 6 month leases, you can do 15-month leases. Always make your leases expire maybe in the months of March, April, May. Um, that way it's easier to rent if you do it that way. Johnson County, the average rent there is 2,050. The cap rate there is 4.5 to 5%, so a little bit less. Really strong area, 14 to 21 days to lease, and really good numbers there in Johnson County. Wyandotte County, 1,350, 7 to 9% cap, 25 to 35 days of rent. 1,400 to 1,600. I'm really looking in this Wyandotte County area. I like Kansas. I like what they have going on. They're bringing in a lot of business. They're getting the Chiefs. They're doing so much development out that way. Their government is a lot smarter than the Kansas City, Missouri side. And so while Missouri is losing stuff, Kansas City, Kansas is winning and gaining. And so I like that Wyandotte County area. And you know me, I just stay out of the inner city. I don't do anything in the inner city in Wyandotte County or in Jackson County. So a real simple underwrite for the investors listening. If the entire neighborhood has 2 car garage, you're pretty much in a good area. And that's real simple. And so I'm always looking for homes with 1 or 2 car garage. They got to be at least 1,000 to 1,200 square foot. And so these are good rentals that you can try and buy here in Kansas City. And if you guys need help, of course, you guys can reach out to us. We have all the companies that you will need in order to develop a portfolio here in Kansas City. Okay, so World Cup 2026, let's talk about this. The economic impact is going to be $653 million to the city. There's 650,000 visitors expected, and the revenue for short-term rentals is estimated at 105 million bucks. So you need to jump on this if you have rentals that are vacant, rentals downtown, rentals close to the stadium. I mean, I would say within 30 minutes of the stadiums, people are going to be looking for properties. The average host earnings going to be about 3,500 bucks, and they still need 500 more listings. And so it's just crazy when you look at, a normal per night average stay is 190 bucks, and during the World Cup it's going to be $435. A home in Midtown might be a 3-bedroom home, might be 263 a night, it's going to be 880. And so there's going to be a huge increase in the amount of rent and what you can charge and what you can make during those 3 months. So I've taken a few of my properties, my apartments, my stuff downtown. I've got them furnished, and I've also created another page where I'm giving people homes unfurnished, and I'm allowing them to get mattresses, get microwaves, whatever they need. I'm just providing them the house with heat, air, and electricity. And they can get air mattresses, they can buy whatever they want, microwaves, spoons, towels, whatever they need. And I'm renting it at a lower price. And so this is to eliminate vacancy and just homes that I have vacant laying around. If I can rent it to somebody for a month and get $400 or $500 a night on a 3-bedroom house and let them furnish it, let them do what they need, I'm in. Sign me up, brother. So that's a page that I started that we haven't released yet, but it's coming. And it's a World Cup page. For the thing I didn't like about Kansas City is they only gave us 3-month permits. And to sit here and decorate a house for 3 months and then you lose your permit didn't make sense to me. So I've done it on a couple units, a couple apartments, smaller units where it's cheap. But what I didn't do is kind of my houses, my big houses. And I kind of just had this thought in my head like, man, what if I just gave people the homes and let them furnish it themselves? They can leave all the stuff when they leave. And, they'll go buy air mattresses, they'll go buy microwaves. A lot of people are in another city. I know when I'm in another city, I might cook breakfast and then I'm out eating, drinking, relaxing. I'm not sitting in the house. And so a lot of them will just need a place to crash. So I thought maybe developing a page, which we will be releasing here shortly, where you can put your houses on there that you have that are vacant, and to see if people will take them. So I don't know what the market is out there for that. There's no Airbnb, there's no VRBO. So this is just going to be all plays that I'm doing off of Facebook, and we'll see what happens. Let's move on to a couple of sponsors. We've got the real estate mentorship program. If you guys need help, if you guys need guidance, if you guys need anything when it comes to Kansas City, go ahead and sign up for this program. I made it real cheap. It's 250 bucks. It's online, it's self-paced, and you have access to me, my systems, my processes, my network, and it's a real cheap way to get into real estate and to learn and to get answers really quick on stuff. United Real Estate's another sponsor. This is a company that pays 100% commission, real estate brokerage, $550 transaction fee, and you keep all your commission. There's amazing support. There's 3 brokers that are full-time, technology, education, and lots of stuff going on. I see you, Romy Rome. I'd love to have that offer with no furniture deal. Yeah, I think a lot of people are never thought about that, but once I say this, you're gonna watch people are gonna start getting smart. Like, hey, we don't have to decorate the homes; we can just furnish them to people and just unfurnish them, give them to people, charge them $400 or $500 a night. What a killer! And so I think that's gonna hit. But back to United, that's a company. If you're a real estate agent, if you want to be a real estate agent, you're going to want to reach out to Marta, my wife, and she can get you connected and get you all set up on the real estate side. We also have mortgage. We're with Midwest Premier Lending Group, which is a branch of Nexa. And what we have here that's really awesome and unique is we have a program called the Business Development Marketing Program, which allows professionals to market our products, and we can pay those professionals a marketing fee. So real estate agents, roofers who right now, the hail damage we just had and all the roofs happening, I've got roofers out there financing people, and basically they're bringing them to me. We're refinancing them, and they're paying for new roofs and new furnaces and new HVACs through the refinance. And so, if you're a real estate agent, an influencer, anybody who has influence, who can market loan products, we can legally pay you. You don't need to be a loan officer, and we can legally get this done for you on on the mortgage side. It's RESPA compliant. You'll be a W-2 employee of Nexa, and you can earn up to a half a point on every loan. So on a $300,000 loan, you'll get a $1,500 commission. And so if you're an agent and you're referring your loans out to people or loan officers for free, you need to stop doing that. You can make an extra half a point on all these deals through marketing, through our marketing company and through our marketing ventures, and you can make an extra $1,500 on a $300,000 loan. Start making 3.5 points on these deals instead of 3. And so compensation is based off of marketing activity. We don't really pay for referrals. We pay for you to market our programs, market us. And so I have to put that disclosure in there. The QR code is here. If you're interested in something like that, you can just DM me. You can get with me, email me, text me, and I can put you in contact and get you all set up. It's really quick. Takes like 30 minutes to get set up. And so that's all the warehouse type stuff we have to do. Now let's talk about cost seg. And so we're coming live from Kansas City, and I've got something special for you. We're talking about real money here. Money that you're giving back to the IRS every single year because you don't know the tax code and what the tax code is giving you. And as investors, we're sitting here grinding, we're building portfolios, we're working nights and weekends and on vacations, and then we're writing properties off over 27 and a half years. And while the government's holding your money when you're doing that, the money should be in your pocket, funding your next deal. So this is what cost segregation is all about. And I promise you, after this episode, you'll never look at the real estate the same way again. If you own big commercial, apartments, even single family residential, you have to be doing cost segregations. This isn't a loophole. This isn't a gray area. This is in the IRS tax code. It's written by Congress, and it's sitting there waiting for you to use it, and nobody's using it, especially on single family residential. So we're talking about pulling your depreciation forward, cutting your taxable income, and putting cash flow back in your hands so you can scale faster. And that's what we're breaking down tonight: what it is, how it works, how much you can save, when to use it and when not to use it. And so my guest tonight is a guy that's been doing this since 1999. And while most people was trying to figure out what the internet was back in 99, this guy was already handling taxes and cost segs. He didn't learn cost segregation. He helped build the entire strategy that thousands of investors use across the country. They call him the depreciation doctor. And his resume, I'm going to give it to you straight, is ridiculous. This guy's done almost 27,500 cost segregation studies. That's a lot in 48 states and over $5.4 billion of real estate analyzed. This is not a consultant. This is not an institution. This is a guy that is in the boardroom with me, and he is an actual investor. He works alongside CPA firms, accounting groups, and taking the real complexity out of the tax code and making it a wealth building weapon. And so, what makes him different from everybody else is he's not just a strategist sitting behind a desk, he's also an investor himself. He knows what it feels like, he knows what we're going through, and he knows how to navigate and how to protect your money. And so, he's coming to you from both sides of the table. And so, you want this guy in your corner. Kansas City, let's welcome Jeff Hyatt to the show. And Jeff, you there?
I'm here.
My man, I can
How
hear
are
you.
you doing, Pat?
Man, I'm doing great. You're
That's
looking good. I like the vest.
Thank you. Got the little logo on there. Got the whole thing going on.
Awesome, brother. So let's jump right in, Jeff, and have some fun tonight and kind of relax. And Jeff is a very analytical person, and I want you to dummy it down like you're talking to Pat Grace for the first time, and keep it simple and introduce the concept and exactly what a cost seg is in simple terms.
Sure, absolutely. So, um, if I was just talking to Pat Grace the first time, if we met at a barbecue or something, and you said, "So, Jeff, what do you do?" My question would be, or my response would be, "I help people that own real estate reduce their income taxes."
Yeah,
And typically you would say, uh, wow, that's pretty amazing. Now, if you're a real estate person, you're going to say, well, that's pretty amazing. That would be interesting. If you're not a real estate person, you would go, that is the most boring thing I've ever heard in my life. Please leave me alone and go over there and eat your
yeah,
barbecue some other place. But as you said, we've been doing this work. The firm started in 96. I joined the firm in 99, and there was two people other than myself back then. Um, and we started doing a few projects here and there for Dunkin' Donuts, Domino's Pizza, and Taco Bell guys. And as we progressed, we got referred to a big transaction around the Boston area, which is where I come from. Um, and we saved that company about those investors about $4 million of tax. And at that time, this was in '02, um, we ended up saving them the 4 mil. And one of their CPAs said, you've got to do a seminar for a CPA society. And I said, okay, how would I do that? And he introduced us to the Mass Society of CPAs. We did a seminar for 85 CPAs just outside of Boston. And we went from doing 5 or 10 projects a year to doing a couple of hundred. Fast forward to today, we now have 38 people doing this all over the country, 6 satellite offices, and we do probably 15 to 1600 studies a year, all based around the premise of, if I said, hey, Pat, if I gave you an option to take a deduction today, take a write-off today, or wait 27 and a half years, which one would you choose?
yeah,
And like you kind of said earlier, you're going to take the money now, because if you can retain that money instead of sending it to Washington, D.C., you get to redeploy that money more quickly, grow your own portfolio, grow your own wealth, grow the next generation's wealth with money that is ultimately at that moment then a tax-free loan and an interest-free loan from the government. So you were going to send the money to DC. Now you get to hold that money. You get to say, I'm going to go buy the next building, or
right,
I'm going to redeploy that money and fix up my current building and then be able to charge a higher rent.
yeah.
Now, the reason a lot of, oh, go ahead.
Go ahead, Jeff.
I was just going to say the reason a lot of people get kind of anxious about it is, they've heard something from an accountant somewhere that said, oh, well, you're going to get that depreciation anyway. Yeah, he's right. That accountant that said that to you, you don't have to pay for a cost seg to get the same write-off. It's just the cost seg is going to be needed if you want to take it early. And with the new tax laws in place, the 100%, what they call the one big beautiful bill, it reinstated 100% bonus. And where people get confused on the bonus conversation is related to what does the bonus, the 100%, apply to? And so, do you want me to just dive into where it
Yeah.
applies?
Yeah.
Okay. So, when you buy a property or build a property or renovate a property, automatically the tax code is going to force you into 27 and a half year write-off. So that means whatever you paid without a land, so taking out land being non-depreciable, but everything is going to be then divided by 27 and a half years. So if you paid 500 grand for a property, and let's say we say land, dirt, the parcel is worth 100 grand, you're going to be writing off a $400,000 building, as it would be called, or a depreciable basis, technically. 400 grand divided by 27.5. And your accountant would say, okay, that's cool. That's what it is. But would you rather take a piece of that earlier? So what if you could take 20% of that earlier or 25% of that earlier? Well, that's what a cost seg does. It says, wait a minute, you got 400 grand. You can take some of that sooner, i.e., in this case, it might be 80 to 100 grand that you get to write off immediately in 5 years and 15 years. So you get to move pieces out of 27 and a half. In other words, call it 100 grand for this conversation. 100 grand you get to take as an immediate write-off. Depending on your tax rate, that's going to save you about 40 grand. So you saved yourself 40 grand, and what can you do with that? Well, you can fix up the place you bought and then charge a higher rent. So I'll let you ask any questions and keep me on track, because I can go into tax dorkdom real easily.
Yeah.
I don't want to do that to you.
So I was this way. So I bought a lot of property. I owned a lot of I had a big portfolio and never did cost segs on my single families. I only did cost segs on my commercial, my big apartments, stuff like that. And that was one of the big mistakes that I made, is I had a couple hundred homes that I never ran cost segs on, and I finally did them. And I think we saved almost 3 million bucks in taxes. And what's crazy is that I sat here and paid between 700 to 900,000 a year in taxes on stuff I didn't have to do, because I just was not educated and I didn't know that. And I was told that it doesn't make sense to cost seg the single family house. And so, can you touch on that a little bit?
That's a great question. So everybody thinks, oh, it's got to be cost seg is only going to apply to those big buildings in your background there, Pat, the big skyscrapers. And yeah, we've done buildings like that, and that makes all the sense in the world. But we've done lots of single families or short-term rentals. So anytime you've got a depreciable basis, in other words, as long as you've got about 300 grand to play with as far as purchase price. So maybe you paid 350, we sub out 50 grand for land, subtract out 50 grand for land, you're writing off 300. Now all of a sudden it's going to make sense to do the cost seg, even down to 300 grand. So it can work for single families, it can work for short-term rentals. So it can work on anything, because again, you're going to take somewhere between, on the low end, 15%. So maybe it's going to be on a $300,000 property. Maybe it's going to be, call it, I don't know, 40 grand accelerated, on up to 50 or 60 grand accelerated, all of which saves you taxes. And if you stack up a few of these in a row, bam, 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 they can really change your dynamic.
Yeah.
And where that can help you as Pat, or you as one of Pat's possible clients, is maybe you have a portfolio just like Pat did of 2 or 5 or 10 or 20 properties, and you've never done cost seg. and you're trying to get to that next property, that next purchase up. Maybe it's just a bigger portfolio, maybe it's a bigger multifamily, maybe it's an office building, retail, whatever it is. But you just don't have in hand right now the money to throw at the deposit, or the LTV with everything you've got is just not there and it's not going to pencil. But wait a minute, what if you did a retroactive cost segregation study? You go back, grab that 50 grand, 60 grand, 100 grand of tax deferral, and now you can throw that money that was going to be sent to DC into the transaction with Pat's folks, and bam, all of a sudden you are over that LTV you need, or you've got enough to put down the deposit for that property you wanted to get into.
Yeah, that's really smart. Tell the audience what types of properties qualify for a cost segregation study. And to follow up with that, at what point should an investor consider doing a cost seg? So you said 300,000 on the single family. So what types of properties can they cost seg, and at what point should they consider it?
Good question there. So any kind of property that has investment component to it. So if you're renting it out, you've got to account for that dough. So it's showing up somehow, some way on your tax return. So it could be single family, could be multifamily, could be short-term rental, could be a hotel, could be office, retail, whatever it is. Now that's the generic category. Those are the generic categories of what would be eligible to run a cost seg on. Now the question I think maybe you were asking, Pat, was, well, what items would you be identifying that would go into the faster life? And what I'm going to start with is kind of a mental journey here of you driving from wherever you live day to day in your primary residence or your office, and you're coming to the property you've just bought. And people go, okay, so what's eligible? What are you going to identify that my accountant can't identify? Well, you're driving down the road, let's say it's Main Street, and you come to your property and you turn in the driveway. Well, people go, well, okay, that's the land. What do you got? You got nothing there. Well, no, that's wrong. So you've turned off the main road and you're on a driveway. Well, the driveway is 15-year property. So whether that driveway is gravel or asphalt or cobblestones or whatever it is, it's 15-year property. And people go, okay, well, that's asphalt, big deal. Well, but it's not just asphalt. There's compacted gravel and soil underneath that to make a good base for the asphalt. So you can take that in 15-year life. And then there's, you got to get the water off of the driveway or wherever, you got to divert it. So it's going to have drainage ditches, retention ponds, maybe there's a pond out back that holds the water and stabilizes it before it goes running into the creek. Maybe you've got a fence out there. Maybe you've got irrigation systems. Maybe you've got shrubs and planting beds and mulch beds and sidewalks. Oh, but wait, you've got outdoor lighting. So you've got underground conduit that takes the electricity out from the house to wherever it goes, around the patio, around the driveway. But it's not just the conduit. It's the trenching that had to go in to put the conduit in. And then you've got compacted soil and gravel around that because you had to do something special. You can't just dump the dirt in. It's gonna recede. So you've got to compact it first. All of this adds value in the 15-year category. Now we're going to go inside the properties because we just keep in mind, we just drove off the road.
Right.
And we now are in the parking lot. We've opened the car door and we're going into the house now. So what's going to happen there? Well, there's going to be, let's say, blinds on the windows, then the doors, and you're going to be walking on, let's say, some sort of floor product that might have a faster life. Like maybe you've got the new jazzy engineered flooring, maybe the LVT. You've got the wood-looking engineered flooring. So you've got that will go into a faster life. Then oftentimes you get into a kitchen space. And so not only the appliances, everybody goes, oh, the refrigerator, that's $800, big deal. Well, But it's not just the refrigerator. What about the wiring to support the refrigerator? What about the plumbing line from the sink, from the water supply to the ice maker? What about the range and the hood that goes above the range? Oh, and then there's a microwave, and then there's wiring for that, and then there's under cabinet lighting. Even the cabinets oftentimes will fall into the faster life. The countertops, the sinks in the kitchen go into a faster life, and the plumbing, the S-trap and all, to go take the water away from the sink, the dishwasher, and the hookup for that. And then either carpeting or whatever else is on the floor. Maybe there's specialty wiring for an intercom system or wiring for the monitors on the walls. We used to call them TVs. Now they're called monitors. Okay, whatever. So those are all things that can go into the faster life. If you've got multiple sources of light, i.e., your primary light might be recessed can lights, but then you've got a fancy chandelier, or you've got sconces on the walls, or you've got down lights that illuminate pictures on the walls or whatever. So there's a lot of stuff on the inside. So the combination of the 5-year inside of the house and the 15-year outside of the house is going to range somewhere between, call it 15 on the very low end percent, 15% on the low end, to 25% on the upper end ish.
And so explain the faster life with an easy number. Say 100 grand of stuff on the outside, and then you've got 100 grand of stuff on the inside. When you're talking faster life for the audience, kind of explain what exactly that means in terms of numbers.
Okay, thank you for that.
Yeah.
Again, I have a tendency to go to tax dork. So if we're talking 200 grand that has been pulled out of the long life, okay, so now we can accelerate 100 grand into 5-year life, and your logical brain will say, okay, well, that's 20 grand a year for the next 5 years that is accelerated, and that's true. And then 15-year life, we've got 100 grand for that, and that's going to be about probably 7,500-ish. I may be a little off on the math there, but call it 7,500-ish per year for the next 15 years. So, but regardless, we're accelerating 200 grand. And you would say, okay, that's okay, but it doesn't sound that exciting. But what's exciting is the one big beautiful bill. And the one big beautiful bill says, wait a minute, Pat, your logical brain, Pat, just said 100 grand divided by 5 and 100 grand divided by 15. That's okay, but oh well. But one big beautiful bill, or technically act at this point because it passed, gets to you get to take 100% of any 5-year and any 15-year property in the first year. So that means Pat just bought that property for, call it 600 grand. We pulled 200K out of it into a faster life. Pat gets to take a $200,000 deduction against income from that property. So you get to take, and that would then save you about, depending on your tax rate, let's assume you're at about a 40% tax bracket. That would save you about 80 grand of income taxes. So it's a $200,000 deduction, but it's about an $80,000 income tax reduction.
Right. So that's the power of the bonus depreciation and the cost seg wrapped into one. And I kind of wanted him to give you the numbers with real, just simple numbers on that, so that you guys can understand that you might get a $200,000 tax write-off that might equate to an $80,000, I guess, write-off on your taxes. And if you're at maybe a lower tax bracket, a 20% or a 30%, what does that do for them?
That would, okay, so at 30% tax bracket, if they're at 30 with Fed and state,
just be
so
less.
they're taking 200 grand, that's a $60,000 tax savings there. So, it all becomes real money real quickly. And the beauty of that is it ends up rolling If you can't use it all in the first year, you get to take it the following year. It's
Yeah.
called a loss carry forward, and that
Yeah.
will automatically happen.
So it rolls over.
It rolls over. And the
And
way to think of it is, Pat, if that happened to you and you said, "Gosh, I can't use all this in 1 year. I don't have that much taxable income, but I need to use it over the next few years." Think of it as you're starting out the next year with a tax gift certificate in your back pocket so that you know that next year, oh, wow, I've got 40 grand as a deduction left from last year. Plus, I'm going to buy a few more properties in this year. And you can just keep stacking up the tax benefit there.
yeah. So I hope you guys can understand and see how the cost seg can improve your cash flow, because it creates less of a basis. And so your cash flow is better. You have a lower tax amount day one. And so now you can't cost seg flips.
Yeah, that's kind of a drag. So, um, but here's the deal: if you're strategic, so what Pat just said, um, like if somebody was just a buy and flip, buy and flip, buy and flip, and that's all they ever did, I'm probably not going to talk to them. And it's not that I don't want to talk to them; it's just that I'm not going to be able to help them because the tax code doesn't let you depreciate properties that you're just buying and flipping. And you say, okay, so what? Well, here's the deal. And where I started to go was if you're being strategic and maybe you're going to do, call it 10 or 15 flips. If you can make it 12 flips and retain 3 of those properties because of whatever metric you're looking at, but you keep 3 of them, maybe you can use the cost seg on those 3 to maybe help wipe out the income tax on the flips.
Right.
So now you can strategically use what you're doing anyway, day to day in your flip scenario. Now you're able to utilize the tax code very effectively. And if you end up just not liking that property, the 3 you kept from this year, you just don't love them for whatever reason, they're not working for you, whatever, and you decide you want to do a 1031, you can then defer the tax on the gain, which you can't use 1031 on flips. So that's another tool you give up if you're flipping.
Right.
But now, if you've held them, the 3 that you kept, you could sell them, do a 1031, and then you've already done the cost seg on the sale, but you can do a cost seg on the property you're acquiring next.
Right.
So there's lots of tools here
Right.
that come into play.
And so the smart play for the investors listening out there, and what I do is I purchase these properties, I fix them to rent, I keep them as buy and holds. I have a huge portfolio like that. I can 1031 those properties once I've owned them for over a year, and I can cost seg those properties. And then as the tenants move out in year 2, in year 3, in year 5, at that point, I can choose to sell some of those properties and I still got my cost seg, I still got my 1031. So talk about the recapture and that whole scenario and that whole process and how that works.
So it's a great question. So the scenario with recapture is we normally would tell people, hey, Pat, if you're buying this property this year and you're only going to hold it for a couple of years, you shouldn't do the cost seg unless you're going to do a 1031. In other words, if you're only going to hold the property for a year or 2, you're going to have to give back so much of the tax savings that the cost seg just gave you. It's probably not going to look that exciting. In other words,
you 1031.
Unless you 1031.
Right.
If you 1031, then life is good because the 1031 allows you to defer the income tax on the gain, plus you kick the can down the road on the recapture as well. So
Right.
it goes down the road too.
Right.
So that's a good thing. And then In theory, you would just keep going with the 1031s until generation one dies and the properties go to generation two, and everything resets with what they call a step up in basis. But let's say you said to me, let's say your fact pattern was, hey, Jeff, I'm buying these properties. I want to do a cost seg on them. I'm only going to hold them for a year or two. I'm going to put some paint on them, let them, the ARV go up, and then bam, I'm going to sell them. Well, good for you, Pat. If you're not doing a 1031, then you're probably not going to want to do a cost seg because you're going to pay for the study to be done and you're going to have to give back a lot of the recapture, a lot of the tax savings I just gave you. On the other hand, but go ahead.
Yeah, no, go ahead. In the recapture, you're going to have to pay it. Yeah.
You're going to have to give, so that you're going to have the tax savings that I gave you at first. Now you have to give it back with what they call recapture. Now, but wait a minute. What if you said, well, you know what, Jeff, after say 3 or 4 years or 5 years, I might be interested in selling then. I'm going to hold it for that amount of time just because of whatever reason. Then all of a sudden it could make some sense, because if your accountant knows what they're doing, typically there are some adjustments that can be made on the way that recapture is calculated, because you've kind of been allowed to take more of that depreciation. Whereas if you're only holding it for a year or two, you've been able to take 5 years worth of depreciation in that first year. But if you're selling it at year 4 or 5, I'll say, and it's not exactly correct, but you've earned the right to have taken that depreciation. And so upon sale, sometimes the book value of the asset has gone down, and the accountant would often make some adjustments there. That's not part of what we do necessarily, but it's part of what the accounting firm would do for you.
Yeah. How long does it typically take to complete a cost seg study?
Our normal turnaround time would, from getting the green light from a client, normal turnaround would be about 6 to 8 weeks. Now, if you said, oh my gosh, Jeff, that's just not going to work for me, we need to get it done faster. Okay, no problem. We've got 38 people. We can get it done quicker. But just like, if you send something via, let's say, FedEx, and it can get there next week, it's going to be cheaper than saying, hey, I want it done in 3 days or 2 days. We can get it done quickly. It's just a little more expensive to do it that way. And
so the reason it takes 6 to 8 weeks, so a cost seg study, like a process for the cost seg study from start to finish, kind of real quick, what does that look like? For the person that doesn't know what a cost seg study looks like.
So the IRS has very specific requirements for a cost seg to achieve, and things have to be in place. And if they're not in place, the IRS can disallow, or upon audit, they can negate the report that somebody used. In other words, the IRS says very specifically in their audit techniques guide, it's how they communicate to, let's say, CPAs or enrolled agents. They say, hey, there are certain things, and in the audit techniques guide, you have to have for a cost seg to stand up upon audit. And that's an actual site visit. So the IRS says very specifically, you can't use, let's say, a desktop driven or AI driven cost segregation study. You can't use virtual site visits. You can't use remote site visits. If you see that on the internet, watch out, because upon audit, the IRS has been disallowing those, because the IRS cannot confirm that a cost seg was actually done at 123 Main Street, or was it done at 456 Main Street, or was it done in some AI studio? So they disallow them. And the real problem is not that they're going to disallow it 15 minutes after you submit your tax return for tax year 25. That won't happen. It's going to be 2 or 3 or 4 years from now. And they're going to come back to you and say, hey, you did a cost seg, can we see it? And it's going to say virtual or remote or non-physical site visit. And they'll say disallowed. So not only are you going to have to pay the tax you didn't pay before, but you've got penalties and interest that have been adding up. So it can become an ugly matter.
Right.
Um, so, but
So you need a visit.
by a qualified professional, we come out and do that visit. So in that visit, we're going to identify everything in the building, not just the accelerated stuff that I mentioned before, but also the not accelerated stuff. So we identify everything at the property and put values on everything at the property. So we identify and quantify, meaning we count, because
Right.
that's what we do, because we're tax doors. And then we put values on it, and then we put those quantified items into the various tax lives. That's what takes the time. Most of that is done off site. So we would send the person in, they're going to be there. If it's a single family rental, probably a half a day. If it's a bigger multifamily, it might be a day, it could be several days. But people come in, we do our site visits, and then go back to the office and crunch the numbers.
And draw up reports and put them in different buckets
Right.
of what is 5 year, 15 year,
You
you
got
know,
it. That's
and
exactly right.
okay. Um, is it better to do a cost seg right after the purchase, or can it be done later? And can investors retroactive properties they already own?
Yes, yes, and yes. So it is typically if you so now keep in mind, I'm a tax guy, and there's that saying out there, you've probably heard it. If you're a hammer, everything's a nail. Okay. Well, I'm a tax guy. So I'm looking at stuff and going, okay, I'm going to look at it from the tax perspective, which may not necessarily work for an investor. But let's say we're going down this path and you just asked me that question. I would say to you, it would be best for you to initially, when you first buy the property, have a cost seg done, because we're going to give you the baseline understanding of every single value at or in the property. And you say, okay, so what? Well, that allows you to grab the 5 and the 15. Yes. But then you've put values on the roof and the windows and the doors and the HVAC. And you say, okay, well, Jeff, those parts aren't accelerated. And you're right, Pat. The roof, windows, doors, HVAC are not accelerated. But let's say a couple years go by, you've built up a little cash, it's stabilized, things are good. Tenant leaves, and you're going to go ahead and renovate and upgrade so that you can charge a higher rent at that time. Okay, great. Now you can end up doing a mini seg on the renovations you do, because you just did a bunch of renovations. You maybe redid the kitchen, redid this, redid that. But in the meantime, you get to take a write off on that old roof that you threw in a dumpster. Since we identified it in the baseline in the beginning, you can then take a write off on the roof or the windows or the doors or the HVAC later on. So you get to reuse the report at that time. And it becomes, you get to take multiple bites at the tax apple with that information.
So it's best to do it as soon as you purchase and rehab.
Correct. It can. It can make sense. Now, if you've, because one of your follow up questions there that I gave you the yes and the yes as well on was, what if the person already owns it and they've owned it for 5 years? Well, you can step back in time and say to the IRS, hey, listen, we took this much straight line depreciation. We should have taken this much depreciation. We're going to grab that now in this tax year. So
Mm.
you could do this for tax year 25 right now. You could still do the study, assuming you're on extension. You could still do the study and use it to knock down the tax impact of tax year 25. In other words, maybe you did 10 flips last year, but you own 5 buildings that you bought in 2022. Well, we could step back to those 2022 properties, do the cost seg, extract the tax benefit, and wipe out your tax, or knock it down, the tax you were going to pay on those flips.
What if what if you have like new construction and you've got a house that has been under construction for a couple years and you have it's not in service yet, but it's coming in service in 26. Would you do it in 26, or would you do it the year it started the construction, or how would you do that?
So you gave me some specific points there, so I'll deal with those points that you gave, which was you started it several years ago. It's not in service yet. In other words, it's not creating cash flow for you yet.
Right.
So that means you cannot take the deductions until it's in service.
Ah,
So what that means is you need to wait until you're renting it, but then once you're renting it, bam, you can do it. If you put it in service in 26, then we would do the cost seg. Theoretically, it would be a little bit easier to do before you start having people in and out of the building all the time, whether it's short-term rental or any other thing. I mean, maybe we could get in there quickly enough and you wouldn't have any disruption or have to get permission from the tenants to come by. But let's say there are already people in there. Well, we can do the cost seg for that new property with the tenant in or without, and you would be able to use it for tax year 26 income tax reduction.
the what documentation do you need to stay compliant with the IRS?
So what we typically get are appraisals from your transaction when you bought it. Maybe if you, like you were just saying, if you were building it from the ground up, you're going to have building plans.
Right.
You're going to have invoices. Now, if it's a smaller project, you probably won't have an AIA, American Institute of Architects request for payment form. You may not have that if it's a smaller one and you're dealing with, Bill, the general contractor guy. But he's going to give you something that is tracking your spending, i.e., maybe it's going to be your QuickBooks. Maybe it's going to be a custom invoice from Bill, the builder guy. Whoever it is, you're going to have some idea of what those costs are. And so we would get that. We would get your depreciation schedule from the accounting firm that you use that talks about what you've taken in years past and what you call the land building ratio then.
I see.
And
How much does a cost seg usually cost?
it's going to be somewhere, it's hard to tell. And one of the things that if people reach out to me via this channel and they just ping me a quick email, which is you had my contact information there, we'll give them a complimentary estimate of tax benefit before they spend a nickel.
Yeah.
And what I mean by that is we'll tell them, hey, because we've done so many of these, we can give them an estimate of what they're going to save and they can decide if they think it's worthwhile. We'll also tell them at that time exactly what the cost is going to be. So they'll know how to, if they want to do it.
It differs so much depending on the property. It's how big, the size, how many units.
Right.
Yeah, I can see that.
And one of the things that what we usually find is that if kind of that old saying of, is the juice worth the squeeze?
Yeah.
So what most people look at is, and they say, hey, if I spend $1 on the study, if I spend $1 and I save $4 or $5 in tax, so you give me $1, I save you 4 or 5. Most people will say, hey, that's a good deal. Let's do it. Well, we get over that threshold or over that hurdle at about 300 grand. So as long as they've spent more than 300 grand to buy the building, build the building, or renovate the building, it's going to make sense for most people.
Right. Yeah. And so I guess that's the key. That's the formula. That's the number, I guess, is a good baseline is 300,000. What's the biggest mistake that you see new investors make regarding depreciation?
Probably, listening to the CPA who's just immediately shoots it down and says it's not worth doing.
Yeah.
Again, or I guess I don't think I've said it this time. Maybe I did. Only 30% of the people, only 30% of the population out there that could take advantage of this does take advantage of it. 70% of the people miss this altogether. And I've been in meetings with clients that have huge portfolios and they completely walked by it because, my accountant said it wasn't worthwhile doing. And I just go, okay, was it the accountant's money that's paying those taxes every year or is it your money? And when people go, well, that's my money, of course. And I said, well, then you might want to look at this, but if you're not worried about it, I'm not worried about it. So
Yeah.
um, it's crazy.
Explain to people how I guess we kind of spoke about the cost segregation combined with other strategies like the 1031. How does the cost seg impact the future resale or capital gains?
There's really no impact on that in terms of it's not going to prevent you from selling. If you get the offer to beat all offers and you want to sell, then go ahead and sell.
Yeah,
And just understand, typically you're not going to sell unless you're getting a nice profitable offer. And if you get that nice profitable offer, you're going to sell it. You're going to take the money, potentially take the chips off the table, and that tax savings I gave you 3 years ago or 4 years ago, you might have to give some of it back in that recapture thing unless you're 1031ing. But
1031. That's the
most of the people watching this program have the real estate in their DNA. So they're not probably just going to say, okay, Pat, I'm going to take the money and go buy crypto. Typically, they're going to say, I'm going to go buy another building.
right.
At which point 1031 makes sense.
Yeah.
Um,
How important is, okay, so we talked about the CPA a lot. I want you to touch on that a little bit and how important the CPA or the tax advisor is in this role. And I know, like, when I was first doing my cost segs, I really didn't understand the concept. And so it was very important for me to have the cost seg guy talk to my CPA. Do you and explain how you guys can kind of work together with the CPA in order to make that happen?
Sure. So, as I mentioned, we started out and pretty much only marketed through CPA firms. And so we were very proactive. Our founding members were initially CPAs. And so and we still have a good number of CPAs and tax focused people on our team of 38. So we've got the staff that can talk CPA to CPA. And so when that CPA says, well, when I'm entering this on the 45, on the tax depreciation schedule, what am I supposed to put here? And my team can say, well, on that line, number 17, you're going to say this. But
Yeah,
on line 19, you're going to say that. And we do that all the time. That's part of what we bring to the table.
perfect. Yeah,
So,
that's a good answer there. Okay, I got a couple more questions and then we'll call it quits. What trend are you seeing in cost segregation for 2026 and beyond?
well, more and more people are beginning to realize that just to use the cost seg once is kind of like saying, I'm going to buy a car, I'm going to have it filled with gas when I drive out of the dealership, and I'm going to drive it until I'm out of gas. And you only use the car one time, which is senseless, of course. And I would say, well, obviously nobody's going to do that. But I would analogize that scenario to using a cost seg only once. And if you get a properly completed cost segregation study, you can use the report again and again and again in the future if it gives enough detail about the items that aren't accelerated. So that's become a bigger trend, especially in our world, where more and more CPAs realize, hey, wait a minute, my client is going to be doing renovations, because if you own a property for any amount of time, you're going to have to get rid of the old HVAC, the old roof, the old windows, and you get to take that.
Man, I'm glad I asked that question because I did not know that even. And so I appreciate you saying that because I thought once I cost segged the property, that was it. So I didn't know that you could continue doing it with renovations that you continue doing to the property.
You can do a cost seg on the new renovation dollar amounts, yes. But I'm saying on the old report that you have, if it's got the right amount of information about and some providers don't give the same amount we do, but you'll be able to use the old report to take write-offs on the stuff going in the dumpster.
Okay.
I want to compliment you though, Pat, just a moment here, because as I was listening to your intro, you were giving away a lot of pro tips there about, like, I had never thought about renting out a property for your short-term rental, as you were saying, without stuff in it and just letting the people kind of go and get their own stuff. And if that works and you can garner some of that business, good for you, go for it. The upside of that for your investor folks out there is that could put them in a category where they can use the losses not just against the income from that property, but also against their day job income.
Mm.
So if they were an investor, if they were, maybe they're an attorney or a doctor, or they run an auto body shop and they've got extra money and they're buying these buildings from Pat, these properties, these homes from Pat, and they're renting them out. If they're doing it as short-term rental, they can use the losses created from the cost seg potentially to wipe out not only the income tax from the short-term rentals, but also against their day job income.
So let me ask you that real quick. Is there more of a benefit for short-term rentals than long-term rentals when it comes to cost seg?
Yes and no. So ultimately, it's the same thing, other than long-term rental. It has the apartment depreciable life, 27 and a half year.
Uh-huh.
And you say, okay, so what? Well, short-term rentals like Airbnbs are not treated like apartments.
Mm.
They're not. They don't have 27 and a half year. They have 39 year like a hotel. So they're treated more like a hotel. And you say, okay, so what? What's the big deal? I think I want to go the apartment route because it's only 27 and a half year. Why would I want to go 39 year? Because if you do a big renovation on a short-term rental, a chunk of that money is going to be considered qualified improvement property, which we haven't talked about yet, QIP. But QIP will allow you, Pat, to call something that was going to be a 27 and a half year asset if it was a long term. Now you can write it off in over 15 years, but it's bonus eligible. I'll give you an example. Pat buys two houses side by side. He pays let's say he pays 500,000 for each one. And again, they're side by side, twin buildings built at the exact same time. He bought them the exact same day, but one, he's going to do long-term rental, like 27 and a half apartment. And the twin next door, he's going to do short-term rental. And you say, okay, so what? Well, Pat's going to fix them both up so he can get higher rent because they were kind of run down. They were kind of beat on. And he's going to spend, let's say, 50 grand on the bathroom in the long-term rental and 50 grand on the bathroom in the short-term rental. So he's spending the same amount to fix up the bathroom. He's putting spas in both. He's making them much nicer, both of them. On the long-term rental, that 50 grand has to be depreciated over 27 and a half year because it's considered a big part of the building. You got to have bathroom. But you do it in a short-term rental, it's called qualified improvement property, and you, Patrick, would be able to take a $50,000 immediate write-off on that 50 grand.
Mm.
So as opposed to writing it off over 27 and a half years, which isn't a lot every year, he now gets to take an immediate $50,000 write-off, a deduction. So it's a big deal, especially when you start to stack up numbers like that. So that can be a very nice advantage of doing short-term rental versus long-term.
Yeah. What if you buy a home, you live in it a couple years, and then you rent it out? What happens then? If it was like your primary and then you turned it into a rental?
So typically at that point, whenever you do convert it to a profit, making venture, you would call it in service then, and you and your accountant would determine what the value at that time is, and then it would just land on your depreciation schedule. So you can start to do it from there on out.
I see. I see. All right. So let's look at this. If you, let's, man, we threw a lot of stuff out there right
We
now.
did. We
Is there
did.
anything that I missed that you think is important? And if there's one thing that the listeners should take away from today's discussion, what would that be?
Just don't. So if you're looking to grow your portfolio, understand that the tax code is nothing more than a carrot or a stick. Okay. So the tax code incentivizes or disincentivizes. Think about the taxes on gasoline and tobacco and alcohol. They kind of don't want you to do that, so they tax the heck out of it. Think about the tax code for real estate. There's a lot of incentives there. Those are the carrots. And what ends up happening, you get to take advantage of those rules that are in the tax code. So don't just assume that everything is all set and my accountant's doing everything right. They may think of you as just the real estate agent and not the real estate investor or the attorney or the architect or whatever you do for your day job. So
Yeah.
there's a lot of tools in the tax code that people can take advantage of.
Yeah. Yeah. Okay. If people want to learn more, they want to get started on cost segs, how do they get a hold of you?
So it's real easy. You had my info up at the beginning, but my email address is jdh at costsegstudies.com. So there's also at Depreciation Doctor on Instagram. I'm Jeff Hyatt, Depreciation Doctor on Facebook. There's TikTok as well. So I'm on LinkedIn and the social media. So I'm out there.
Yeah.
Just ping me an email. My mobile, if you
Jeff
want to.
Hyatt, Depreciation Doctor.
Jeff, yeah. Well, the at Instagram is just Depreciation Doctor. I'm not great with all this social media stuff, but
Yeah, I met your daughter at Boardroom. She kind of handles all that for you, huh?
she does, and
Yeah.
she knows all the handles, and I'm like, oh, I think it's this one, but
Yeah,
so
that's awesome. Well, I appreciate you, Jeff, for coming through, sharing all this knowledge, and helping our investors out. I hope some people reach out to you and get some business. Are you going to Turks and Caicos?
I'm not going to be able to make it because I've got so many speaking engagements right now.
Oh, wow.
Because we're going all over the country talking about this
Oh,
to
nice.
real estate groups, and so it's just not a good time
Yeah.
right now. So,
Well, I'll have fun for you.
well, please have a couple of beverages for me, and we'll go from there.
I'll have a good time for you. I appreciate you, Jeff. Thanks for being on and sharing all your knowledge and your experience with us. I appreciate that. We're going to tie this show down. Episode 8 is going to be about lines of credit. And man, I am excited for this because this is something that every time I talk about it, people want to know more. And this is the one thing that has absolutely changed the trajectory of our portfolio, our life, and how we operate everything out of lines of credit. We have 0 amortized loans, 30-year amortized loans. And I'm going to go in depth on this line of credit strategy, on how I use it, what I do, how we do it, and how powerful it is, and how much cash flow we have, and how much more access to capital we have, and just the power of using lines of credit. And so the next episode is something that you don't want to miss. You definitely want to be a part of this. This is probably going to be the biggest show we have yet. And just stay tuned. That's going to be May 12th. Put it on your calendar, May 12th, 7 p.m. Want to kind of go over all the sponsors. If you're interested in anything here, you can click on the QR codes, take a picture of this screen. I couldn't really see all the comments, and so I hope we answered all the questions. I try to get to them as they popped up on the screen. You can be on the lookout for the recorded episode. You can always go to YouTube and find all the recorded episodes. You can go to Facebook and find some of the episodes on my Facebook page. I appreciate you guys for coming and listening, and I'll see you guys on May 12th. Here's the handles where you can follow me. If you're interested in buying any property, you need help with purchase, construction, mentorship, consulting, property management, whatever it is you need, look us up. You can get a hold of me. I've got lots of ways that you can get a hold of me, and we'll get you guys situated and get you guys handled and get the help that you need. Thank you guys.